Hello, everybody, and welcome back to our webinar series, Learn to Trade the Market. My name, as always, Stefan Friedrichowski, but the first name is still okay, so don't hesitate whenever you send me an email that you simply name me Stefan. Yeah, and thanks, of course, Argo-Trading, who makes that webinar series possible. And it's a pleasure for me to have you once again with me here after my holiday, my vacation to Colombia, which, by the way, has been a great visit. So whenever you have questions to Colombia, you can send me an email as well. So it was really wonderful to be there. And now I have two problems, not really problems, no. I have to get adjusted to the time shift and to the weather conditions here in Germany. Okay, the sun is good, but temperatures are quite different. So the difference is about 30 degrees of Celsius. So I came directly out of the summer. But Colombia is not the topic for today. It's Learn to Trade the Market, as always, on Tuesdays at that time, 2 p.m. German time. And for the records, the date is 14th of February 2017. Yeah. So what to do for today? First, I want to recap a little bit our first part. And the first part means the previous 5 webinars, just to give you the opportunity to come into the topic quite good, and therefore a short recap of what we have done in the previous webinars. And then I want to switch to more what are trading strategies. So the topic for the next couple of webinars will be trading strategies, so that you know how you can get setups and how and which kind of setups you might use in order to be profitable with your own trading activities. But I will start that topic with a general overview about trading approaches, and then I come direct in the next topic to one specific trading setup, and that trading setup runs under the name multiple EMAs. So you will see what that means and how that will help to find good trades within the market. And if there's still some time, we will do some trading praxis as well, as usual during the last couple of webinars. As always, you will find all the recordings under the link here, and you have already the opportunity to download the slides for today via the GoToWebinar control panel. And then you have all the links, for example, to look to the previous webinars whenever you want to do that. I know the link is quite complicated. And still, I have to mention the so-called risk warning. That means whenever you do your own trading activities, you know, you do it on your own. And yeah, but that is, I think, sure, and you know that part as well. Good. Let me recap a little bit what we have done during the last couple of webinars. It's only 6 points here, but maybe that helps you to come into the topic, Learn to Trade the Market a little bit better. And what we have done is we have been through the trading platform MT4. MT4 is our trading platform of choice. That means we need something to communicate in order to place trades, to open trades, to manage trades, and even to analyze our specific underlyings of interest. And all those things we do with the trading platform MT4, which is quite common in that market. There are other trading platforms as well, but I focus here on the MT4. And what we have done is we have set up specific profiles in order to have a better overview to the markets. We learned how to open trades and how to place really an order. And you learned that there are in principle two types of orders. That is, one is a market order, which always means the trade is initiated immediately, and there are so-called pending orders, so that are conditional orders like limit and stop orders. So in total 4 different types: limit buy or buy limit, buy stop, sell stop, and sell limit orders. Always with those sentences like, I only buy if it's cheap enough or expensive enough. You might remember that we have always one sentence in order to remember what type of order we are doing. So we know how to place orders in the trading platform MT4, and we have introduced one Excel sheet, and a couple of you have already asked how to get it, and just via email you can have it. So just if you still want to have that Excel sheet to calculate the risk of a trade, just send me an email. So we know how to calculate the risk of a trade, which is quite important. We know how to calculate that for forex pairs. We know how to calculate for indices or commodities. So whatever we trade, we know how to calculate the risk. That means immediately that we only trade with a stop loss. And I cannot repeat that sentence more enough. Then we need stop losses, and that is a must, and therefore it's in capital letters here once again. And by the way, only if we have a stop loss we can really calculate the lot size number, so how much we want to trade of a certain underlying, and that's only in combination with the stop loss you can do that calculation. Therefore, it's extremely important for any trading activities. We have set up a portfolio of underlyings, some good underlyings which build a broad range, some commodities, some indices, some forex pairs. So we have in total selected 8 underlyings of our specific interest. That means that we focus right now only on those 8 and nothing else, and that might help you as well in order to have your own first trading activities. Don't trade everything which is possible with the broker of choice. Just focus on a few underlyings. That helps you a lot. We have introduced 2 important indicators in general, and the 2 are the EMA, which is an exponential moving average. So in general, what we need is a moving average, which helps us to identify ranges, or when the market is flat, or it helps us in order to see whether the market has a specific trend direction. So EMAs, or moving averages in general, are nothing else than, as the name already tells us, the average of a certain history, and that improves our view to a chart because we don't look to the noise. We can identify the overall behavior much better. The other indicator has been the so-called ATR, average true range, and that indicator is a measure of the volatility of a market, and that volatility is quite important as well, because think about a market which is highly volatile, which means price goes up, down, on short time scales. Already you have huge movements in the market. That means now to have a stop loss which is tight will not really help. So we know how to combine the information of the ATR with our stop loss setting, and that means if the volatility goes up, our stop loss is more away from our current price. And finally, with a fixed risk per trade, that means that the lot size goes down. And that is always good that we combine volatility and stop loss setting. So those indicators help us to identify trades, and they help us in order to have settings for stop loss and take profit, so that we have a real trade with all numbers, and especially once again, stop loss is quite important. Then we have introduced two base trading setups. You will learn more about trading setups during this webinar and next webinars, but what we have done so far has been that we have two views on the market. One is that we identify a market being in a trend behavior, so going up, going down, whatever, or if a market is more flat, which means the market always builds a range, a horizontal range. Price goes a little bit up, a little bit down, and so on. So oscillates maybe, or whatever the market is really doing, but then it means we find so-called range in the chart, and that means that we have two possibilities to trade that kind of setup. One is that we believe in a breakout out of that range, or that we think, hey, the market will stay in that range. Same is true for the other base setup about trend behavior. There we have two possibilities as well. One is that we directly think, hey, trend is your friend, and we follow exactly that trend. Or that we say, now we have an exaggeration, so market has moved too fast, and now there will be a correction, so that we trade exactly the opposite direction. So those have been our two base trading setups, which means in total 4 trading setups, because we have always two possibilities: counter trend, and breakout or stay in range. Those have been the names of our trading setups so far. Good. That has been done in the last couple of weeks, and I hope that you have done some own trading activities in MT4 or whatever, and that you know already a little bit about the markets and how trades can be opened, how to identify trades, and so on and so on. But now there comes the next real big step. And the real next big step is how to become profitable. Because trading is one thing. We can trade whenever, whatever, long, short, but the question is always, finally, what we want to have is, we want to have an account which increases, so goes to the north. You might have already learned by your own trading activities that it is stupid to think that every trade has to be a winner trade. There are always win trades, loser trades, and 3 in a row, or even 5 in a row, whatever, winner or loser. And that does not tell you anything. What counts is a long-term behavior of your account. Don't look to the short-term behavior, because that is always a little bit random. And you know that from time to time, I make sentences like, if I now identify a trade, a long trade of euro, US dollar, do I really know that that trade will be profitable? The honest answer to that question is always, I have no clue. A single trade will finally end, maybe stop loss, maybe take profit, whatever. For a single trade, if I would know it, that would be nice. But you can imagine that this is always impossible. So what we need is, we need a so-called edge. We need something which is with us, that we, in average, that we are on the right side of a trade. But for a single trade, it's always random and nothing else. If anybody would tell you something different, please don't believe him. There are no 100% trades. If so, you would be rich with exactly one trade. So that is a little bit too short thinking, and therefore, please keep always in mind, trades are only good in a series. So if that trading series goes north, then you are through. But how or what kind of general approaches to trading do exist? And my list is by far not really complete. I on that slide I have or will speak about 5 different trading approaches, but there are even more. But those 5 different approaches may give you already a good overview to that topic of trading approaches. Let's go really line by line through those trading approaches. The first one to mention is what is always called the fundamental approach. There are different sub-disciplines of that. For me, everything is quite similar. Let's start. What is a fundamental approach? For example, you do an analysis of a specific company. You look, for example, to the balance sheet, you look to the profit and loss situation, you look to the competitive situation of that specific company. You might have some further knowledge about what they intend to do. Do they go into new markets, new product lines, whatever. So finally, what does it mean? You build your own opinion on that specific company or, for example, market. Those opinions might derive maybe from political situations as well. For example, everybody knows that now for 1 month we have Donald Trump as the new president of the United States. And yeah, you might have an opinion to that. And that with opinion, I don't mean that you think Trump is good or not. No, that's not the question. You might think, well, Trump is good for the economy of the United States. And if so, then why not going long in Dow Jones or S&P 500? So you create your opinion to a specific market, company, even a currency. Same story, the new president in the United States. You might have a new or other or different opinion about the US dollar. Maybe the US dollar gets stronger, maybe weaker. So whatever is your final conclusion, that is an opinion to the market. And you can do all these analysis quite sophisticated or simply by input of newspapers, whatever, web pages. Whatever comes there is finally creating an opinion. And that opinion can be traded, of course. Still, I would always say, hey, do it with stop loss and so on and so on. But your trading approach is fundamental. That means you build up an opinion to a specific market, company, currency, and then you trade. So that is one approach. To say immediately that approach is good or bad, no answer. I cannot prove any opinion about that. But of course, that is a valid approach to come to trading activities. And it's quite important to have that always in mind. Totally different, maybe not, but when you look really to the general statements is the second part, the so-called technical analysis, or sometimes one can do another step that is called the so-called market analysis. And I don't want to go into the details what is really the difference between technical and market analysis. I leave that to other people. But what is that technical analysis all about? So looking to technical analysis means you look to a chart. The chart is always the first thing you have in mind. You don't think right now in the pure format that you could combine it with fundamental thinkings, but let's first just be pure. So let's look what really technical analysis means. Technical analysis means that you look to a chart and then you might identify so-called supports or resistance within the chart, or even you may find so-called formations, formations like triangles or rectangulars, whatever. There are lots of formations you may find in the chart, and you find a lot of literature about that topic as well. And finally, what you may find within the chart are so-called high-low sequences. That is the special topic of market analysis in a little bit more detail. So you have sequences with higher highs and higher lows, and those would identify an increasing market, so an upward trend. And vice versa, of course. But everything what you do is you do it within a chart. And even if you might have some additional input like market volume, for example, so the traded volume per whatever candle, for example, that is an additional input within technical analysis as well. Once again, to say that approach is good or bad, difficult to say. There's no real proof about that. By the way, that's for all. There's for nothing real proof. Of course, one can say, hey, if I would have entered a long position, a long trade 30 years ago in the S&P 500, yes, then we would have had very good trade. But that is not really the answer of technical analysis or even of fundamentals. A little bit of the fundamentals is true on that, because if you still believe in an increasing economy, then of course indices have to go north on a long-term behavior. But now you see we've start to combine technical analysis, fundamentals, and also that kind of approach is valid as well, and a lot of people are doing that. So within that webinar series, sometimes when we look to charts, I comment those charts like a technical analyst, like, hey, there's a support, there's a resistance lines, or we even draw some lines within the chart. I don't want to make a course out of that as well, because that you can find in every book you read about technical analysis, and that is quite easy in practice. And the question, is the line I draw right or not? there's no clear answer to that. And therefore, there's always a little bit space for interpretation, and you may ask two analysts and you might get three answers. So there's still simply room for your own interpretation of the chart. But that is technical analysis as being a valid approach for trading activities. The third one I want to mention here is not a real trading approach for private trading activities, at least for most of us. And that is hedging. Hedging, what does it mean? Think about that you are the owner of an international company located, for example, in Germany, and you do a lot of business with the United States. The normal contracts with people out of the United States are always done in US dollar. So you get your money in US dollar. You have to set your prices in US dollar. And now you have a tricky part. You want to budget your next fiscal year, and you have a good idea of what kind of revenues you might have with specific products of your company. But finally, to have those numbers in your balance sheet and profit and loss calculation means you have to assume a specific a specific exchange rate between euro and US dollar. And that might change. So you think right now we have 1.06, for example, but what is about the rest of the year? Maybe the euro US dollar goes up to 1.2 or even to 0.9. And now you want to have a little bit more planning security within your next fiscal year. And that means you would hedge the euro US dollar in the same volume you want to have business with your company in that specific economic region. And that means you open a long or a short trade, depends on what number you have within your balance sheet as a base number for the exchange rate between euro US dollar and the actual price. What is good about that? That gives you planning security for your company. And now think about the real big companies like Siemens, like GE, like Samsung, whatever. They have to hedge huge numbers. There are other important input factors for that kind of hedging that finally has to do with where do you manufacture, what kind of payrolls do you have to pay, and so on and so on. It's a quite complicated overall business for a big international company, but the volume which is hedged is quite huge. So what you do there, or what people are doing there, they move around really billions of dollars or whatever currency. And everything is only done in order to have more security, more accuracy in your planning activities for next fiscal year or whatever time frame. And that means you pay, because we learned already that we pay always a spread, we pay swap costs and so on. You pay a much smaller amount of money for that hedging, and you gain planning accuracy, which is not that bad. So keep always in mind that most of the Forex trades have to do with hedging activities. So it's not the way you may personally trade, only if you think about, hey, I want to have holidays in the United States and I have a specific opinion about euro, US dollar, then you might even open a long or a short position, or you might even exchange your money already today. Depends on what opinion you have. That would be a little bit like hedging as well on a private sector, but we keep that trading approach in mind because we have to know what the big players do, and those players have a lot to do with hedging. A fourth approach about trading activities I would like to mention here is what I call the statistical edge. So the probability advantage, or it does not really depend on how you look into that kind of topic. Finally, what does it mean? It means that your trading activities are purely mathematical driven. That might be that you have done in-depth analysis of if I trade the EMA and the price is above the EMA, then I open a long trade and so on. You see already what I mean? It's completely rule-based. That means you set up rules, you prove by looking to the history of data that those rules are okay and have a probability advantage for your trading activities. So that is a huge field for trading activities, especially for big companies, big players, but even for private traders. You can do there a lot, and always that might end in so-called expert advisors, which do the trading activities simply by their own. You might know that that fourth line here is exactly the line I follow most. That means those trades build my personal trading approach, but it's only one method, one approach against all the other. Is there proof that only this one can help, or this one is better than others? Once again, answer no. There is no security within trading at all. So those strategies are mathematically driven, mathematically derived, calculated, maybe adjusted, maybe self-adjusted, and even looking to the near future of that kind of trading activities, there might be learning algorithms like those algorithms we always see. For example, if you buy something at Amazon and then you get an email, hey, people who bought that one, they might buy this one as well, and you can get those kind of recommendations, or you see it by personal advertisement within your browser, which is also driven by those kind of algorithms. So that is the broad field of people. And finally, what you want to do there is you want to find a statistical edge for your trading, which you can turn into an increasing account finally. Let me mention one additional trading approach, and that trading approach runs under the name Arbitrage. I don't know exactly how to pronounce that word in English, so I have to find out. But what does it mean? That means you want to find differences between different marketplaces, for example. So think about you have an information gain simply by maybe only milliseconds or whatever. And you know S&P 500 right now at New York is at 2,111, and in Germany at 2,120. So you see there's a difference, and always one thing is behind the other. So then you have an information gain against other people, and you can use that gain in order to set up in order to trade. There might be other differences you find out. For example, we can trade the DAX as an index, or we can trade the DAX as being the future, the so-called FDAX. And in principle, those two indices, they behave the same. But from time to time, there might be small deviations, which will be corrected immediately by all the other market participants. But those kind of opportunities are so-called arbitrage opportunities. For a private trader, I can tell you, simply impossible. You need extremely small spreads. You need extremely fast trading execution, and with fast, I'm far below milliseconds. So it's nothing I think you can do for your private trading, but at least I want to mention that kind of trading approach, which is used quite heavily. But you need other techniques for that. So that gives you an overview about 5 different trading approaches. And what we will do here most for our things within that webinar series is a combination of 2 and 4. So whatever I will present here as being trading setups are known for that they have a statistical edge. How to derive those things, that is part of my other webinar series, always on Thursday. So if you want to learn about that specific topic, how to set up and how to calculate those statistical edges, that is part of the other webinar. So I will just use the outcome of those trading setups to present those trading setups within that webinar series. And they are from time to time driven or supported by technical analysis in a way that some principal setups can be better described with technical analysis. And then I prove by my own that I can find a specific edge for those setups, and that is what I present later here in my webinar. Personally, from time to time, I open additionally trades which are fundamental driven, and as already introduced, that is more an opinion trading, because I have a specific opinion to a specific market or underlying or company, and that is something I trade additionally. But now to say what are the rules directly, and is there a straightforward format, a specific Excel sheet, putting some numbers in, and finally we know, wow, going long in Apple is good. No, I don't have something like that. So it's still something like an opinion. And what you finally do is you trade exactly that opinion. Having in mind that overview, we go now, and for the next couple of webinars, we go in real trading setups, which I use for trading activities. And those will be introduced a little bit more in detail in the following minutes and following webinars. So one approach for trading I want to show on my next slide. I hope that my computer comes back here now because I have to switch to the next slide. And that is one trading setup which runs under the name multiple EMAs. And yes, the name is already exactly what we are doing there. Let me first describe it a little bit here on my slide, and then we go in practice to the MT4. We will set up the chart for that trading setup, and then look whether we maybe find already a good trading opportunity within our standard portfolio for the 8 different underlyings. So we have talked already about trend trading, which means that we trade in the overall trend direction. But now, since we know that the price never goes in a straight line, so it goes up, down, and if those ups are in total longer than the downs, then this is an upwards trend, and we want to open a long position. But now the question is how to find that end of a correction. That means price goes down once again, and then finally in the overall direction again. And what we can do there is we can improve the normal trend trading approach by a couple of EMAs. And we use simply 4 different EMAs. And for example, we use values like 20, 40, 80, and 160. And you see what I have done. That's always a factor of 2 for the difference between 2 EMAs. So they build up an EMA sequence. How this look like, you will see in the chart in a minute. And the trading setup is simply the following. So we have trading conditions for that approach. What we want to see is that those 4 EMA lines in the chart, that they come together. So, or more mathematical, that they constrict. I think there's an S missing. So that they come together, those 4 EMA values, and if they do that way, then this is our signal to open a trade. Still, we have the question, what trade direction? And the trade direction we choose here is always the slope of the slowest EMA. What does it mean? There's always one EMA which has the highest number, in my case 160, and if that line goes up, we would open a long trade, and if that line goes down, we would open a short trade. You will see in the chart in a minute how this helps you to interpret the chart of a specific underlying, because you will better see this ups and downs, which always build to some extent those series of higher highs and higher lows, for example, so that can help us to find better entries for a trend trading setup. Of course, this setup needs a stop loss and a take profit. As always, take profit is not absolutely necessary, but a stop loss, of course, is necessary as always. And you know that if you set a take profit, then we can use the so-called CR, or in English it's the triple R, for the difference between take profit and stop loss. And in this case, you need a triple R of better than 3, because we have not always, we don't have that good win rate, which is far below 50% with that trading setup, and therefore we need more take profit than the stop loss distance. So therefore we need risk reward ratios of about better than 3 to be on a long term profitable with that kind of trading settings. So let's have a detailed look to that within MT4. So it's quite easy. We go to our standard account, and our standard account or standard view here is the following. So you still see there are some open orders, some ongoing trades right now, but anyhow, let's have those trades here running, and we come to that in the next webinar. But now what we want to do is we want to set up a chart with this multiple EMA kind of behavior. I want to do it here, for example, let's take euro, US dollar, and that means I will make the chart a little bit bigger, so that we have that one right. And what we have here right now is euro, US dollar on a daily base. We have already one EMA within our chart, and that EMA has a period of 200. Let me reduce that EMA value to 160. So let me change that. So now we want to have this as 160, and we want to have that line a little bit thicker. So it will be the fourth line. Therefore, I take this thickness here. And what we do else is we look for additional moving averages, which will be in that chart as well. So once again, we throw that over here, and we go for another EMA value, and that is 80 right now. So let me check. I have a comment that my microphone doesn't work properly. Unfortunately, I don't know exactly what's going on here. I see that my computer activity is quite high. I hope that will be better than that, because I cannot really change anything, because those jobs which are running here are not by my own. It's so the computer itself, which is for whatever reason quite active. So hopefully it will getting lower later. So what we have here, unfortunately I have not taken the right thickness of that line. I want to have that a little bit thinner. So let me change that. So I go here for the third one, and then we will have a better view here. And now we take another moving average, and once again a little bit thinner, and the EMA period choice will be now 40. So let me check what's going on. So now we have it 40 and a little bit thinner. Okay, this is done, and now the final one, that it has an EMA period of 20, and once again a little bit thinner. Good. Now we have it, and you can see already a little bit of what I mean with EMAs come together. Let me zoom a little bit in to the chart here, and then you see first here in the beginning of September, we have sized what movement for the euro-US dollar, and then we start a trend behavior to the south. And you can see going south, correction. Going further south, correction. Going even further south, correction. And that is, yeah, like in textbook, the typical behavior of downward trend behavior, and that is the combine comes together with that EMA constriction. And those EMA constrictions are the one I look in the chart for that trading setup. That means right now, it's now 4, 5, 6 days ago that we have had the biggest constriction here with those 4 EMAs. Therefore, that would have been a good entry point opening a short trade. So right now it's too late, but anyhow, we have other underlyings we can look for that trading setup. But you see, the overall, the slope of my overall, or my slowest EMA is still going south. Therefore, I would have opened a short trade at that time. So it's about 1.5 weeks ago. So let me, that I have it a little bit easier here, I create, I apply this here as a standard template, and by doing so, I can get that template or any other, I could name it differently, but it makes my life here in the future a little bit easier to have that as a standard template, and we can look now whether we can find a better opportunity in something else. So let me take this here for gold that I apply now. That template to my gold chart. Simply by select the specific one here. Oh, I did the zooming not right, so therefore it's still looking like this one here. Let me make the chart big. Then we can we have a good overview here about that kind of trading setup. And you see here there has been a real reversal, and now my cursor is, let me wait a second, and you see when I move my cursor, that was an overall trend reversal, so coming from a downtrend, opening an uptrend here. We have had here that kind of constriction that would have been a good opportunity to open a long trade. Now we have had a second reversal here. So let's be honest, in that point in time, one would have opened a long trade still. We have a positive slope of the slowest EMA. One would have opened a long trade at that point in time, which would have not been a good decision. But you know, there are no 100%. And for that kind of trading setup, we look for a win rate of about 1/3. And therefore, we need the risk-reward ratio bigger than 3 to finalize the Y. Now we have here right now we have that kind of situation that we have constriction of the 4 EMAs. So still the EMA goes slightly south. So this would be now a point in time to open a new trade, and that would be a short trade here in gold. But I will not do it right now. Sansa, my overall sphere for this lowest EA nearly horizontal, so don't have a good indication of what direction I should hit. Or let's wait until next week, then do the decision better. But just see how trade setup works. If in the second, I still have trading opportunity, and maybe we DAX. But anyhow, so we prepare charts that plate in order to set up and run, and even go to time frames is a good shot. For those people who don't want to have a real intraday trading, not below 8 candles to shots, time to one candle. We will do time as well. So overall profile here. Then we have one trade up and we will do that more next week, and I want to use another trade setup probably next week as well. So that's now you will in total 3 trade setups. Which we might use from trading activities, and always will come in product with some practice on trading setups in that you use trading settings setup quite easier for trading activities. So that's for now. If there are any questions, send me an email. Argos@argos.com. You can email me anytime, and make sure that can answer quite quickly, and that you get fast response. Thanks to Argos and having the webinar here, and thank you to participate those chance. I think I hope that everyone went well. It's my microphone was not too bad. I will check for next week, and time. Hopefully, see you next week. Bye bye.